All right, today we are tackling a really fascinating question. When states try to tax their super rich residents, the billionaires, do they actually end up collecting a ton of money, or do they just scare them all away? Well, a fascinating economic study has some answers that are frankly pretty surprising. So let's dive right in.
Okay, first, let's just talk about the kind of money we're dealing with here. Look at this number, $21 billion. That's what the state of Washington could potentially collect in estate tax from just one person. You guessed it, Jeff Bezos. I mean, think about that. That's almost enough money to double the state's entire tax revenue for a whole year from a single resident. The potential upside here is just staggering.
But, and this is the billion-dollar question, literally, does that massive payday ever actually happen? Or does the threat of a tax like this just make the super rich pack their bags and move somewhere else, a state with no estate tax? And if they do that, they take all that potential revenue with them. That's the real puzzle we're going to unpack.
So to really dig into this, we first need to be super clear on what kind of tax we're even talking about. Because this isn't your normal everyday income tax. Nope, this is something way more specific, and honestly, the stakes are a whole lot higher. What we're talking about here is the state estate tax. Basically, it's a tax on a person's entire fortune, all their stocks, real estate, the whole shebang. But it only kicks in when that fortune is passed on to their heirs after they die. And let's be really, really clear, this tax does not affect most people, not even close. We're talking about the kind of wealth held by folks on the Forbes 400 list.
Okay, so the big question remains, do these taxes actually cause billionaires to up and move? For a long time, that was a really tough question to answer definitively. But then, a change in federal law came along and created what economists call a natural experiment. And the results? Whoa, they are pretty dramatic.
So how did the rules of the game suddenly change? Well, for most of the 20th century, there was this federal tax credit. And what it did was it basically made state estate taxes a non-issue for the super rich. It just didn't matter where you lived, your total tax bill was the same. But then, 2001 happened. A big tax reform started phasing out that credit. By 2005, it was gone completely. And all of a sudden, a billionaire's home address mattered a lot. It could literally be the difference between paying zero estate tax and a tax bill in the hundreds of millions of dollars.
So how did billionaires react when the rules changed so drastically? Well, the study's authors don't mince words. They say that billionaires' geographical location is highly sensitive to these taxes. How sensitive? They found that states with an estate tax lose over a third, 35% of their billionaires. That's a massive exodus. And when you look at the data, it's like a one-way street. After this change happened, more than 21% of billionaires living in states with an estate tax packed up and moved to a state without one. Now, compare that to the other direction. How many moved from a no-tax state to a tax state? Just over 1%. Yeah, the money was clearly and very quickly flowing out. And get this, it gets even more interesting. The researchers discovered that this whole pattern gets more and more pronounced as billionaires get older. Which, when you think about it, makes perfect sense, right? As they get closer to actually having to pay that tax bill, the incentive to just move to a state where that bill disappears becomes way, way stronger.
Okay, so at this point, the evidence for tax flight seems pretty overwhelming, right? It really looks like a losing bet for any state that tries this. But that's only half the story. There's a whole other side to this. We have to ask, what about the billionaires who don't move? For the ones who stay, how much money do states actually get?
Well, the study dug deep into the numbers, and the answer is a lot. They found that on average, when a single, unmarried Forbes 400 billionaire passes away in a state that has an estate tax, that state's revenue gets a sudden boost of $165 million. So yeah, a lot of billionaires might leave, but the ones who stay, they still represent a colossal payday.
Now, there's a really important detail here. The official tax rate on the books, what they call the statutory rate, is typically around 16%. But almost nobody actually pays that full amount because of things like huge charitable donations and other, perfectly legal tax planning. The effective tax rate, what the state really collects, is closer to 8.5%. So yeah, it's about half the official rate, but come on, it is still a massive, massive windfall from just one person.
So you can see what's happening here. We have these two incredibly powerful forces pulling in completely opposite directions. On one hand, you have billionaires leaving to avoid the tax. On the other, you have these gigantic revenue windfalls from the ones who stay. And this sets up the central trade-off, the big calculation that every state government has to wrestle with.
Let's break that calculation down. It's actually pretty simple. The benefit is that huge one-time cash injection from the estate tax of a billionaire who stays. That's the upside. But the cost? The cost is all the annual income tax revenue that the state loses year after year from all the billionaires who got spooked and moved away. It's a classic case of a massive one-time gain versus a slow, steady, long-term loss.
So, what's the final answer? Which one wins out? Is the one-time gain bigger than the long-term loss? I mean, based on how many billionaires leave, you'd probably bet the cost is way, way higher, right? Well, this is where the study's final calculation gets really surprising.
The magic number from the study is 0.69. So what on earth does that mean? It's the average cost-to-benefit ratio. It means that for every single dollar a state gains from an estate tax, it only loses about 69 cents in future income tax revenue from the people who leave. So on average, it's actually a net positive. The benefit is bigger than the cost.
But, and this is a huge but, that word average is hiding some massive differences from state to state. It all comes down to income tax. Take a state with high income taxes, like California. For them, losing a billionaire is incredibly costly. Their ratio is 1.45. That means they lose $1.45 for every $1 they could possibly gain. It's a losing bet. Now look at the other extreme, a state like Florida, which has no state income tax. What's the cost of losing a billionaire's income tax payments? 0. Their ratio is 0. For a state like that, an estate tax is pure, unadulterated profit.
So what is the final verdict from all this? Well, the study's conclusion is pretty stunning. Even though these taxes absolutely cause some billionaires to leave, for the vast majority of states, it's still a net financial win. In fact, the researchers looked at all the states that don't currently have an estate tax, and they calculated that every single one of them, with the lone exception of California, would actually bring in more revenue if they adopted one.
And that leaves us with one last, pretty provocative question. You know, the simple story we always hear is that taxing the super rich just doesn't work because they'll just pack up and leave. But the detailed math in this study tells a very different, much more complicated story. It suggests that for almost every state in the country, this policy is actually a winning financial strategy. So the real question is, knowing the math, why are so many states choosing to leave all those billions of dollars on the table?